Junaid, Chief Investment Officer.
This meeting is being recorded and summarized.
Senior Director of Finance Operations. Mr. Nasser Al-Judayi, Director of Actuarial and Data Analytics. And Mr. Abdul Malik Faraj, Director of Business Advisory and Investor Relations. I would like to hand over the call now to Mr. Hatim Jamal. Please go ahead.
Hello, everyone, and good evening. And it's great to have you today with us. In today's session, we will be taking you through our results for the first quarter of the year 2025. You have seen the announcement recently with the results showing another great quarter for Bupa Arabia. And we'll be taking you through the financial performance, market trends, and we will share an update on Bupa Care Connect, which is our provision arm, and we will share some highlights. We will happily take questions through the chat or at the end of the presentation during the Q&A session. So welcome, and I'll hand it over now to Abdulrahman to take you through the first part.
Thank you, Yassine. Assalamu alaikum, and good afternoon, everyone. As a starting point, we typically give an overview of Bupa Arabia, just for the interest of people who are joining us for the first time. Bupa Arabia has been operational for more than 25 years. Today, we proudly have over 2,000 employees, serving 3.7 million members through our different providers in the different networks, which are above 1,450. When looking at our history, our stock has gone public in 2008 with merely a top line of 800 million, spanning all the way to 2020-24, where we broke the 18.3 billion mark in GWP. This has helped us achieve a CAGR of 21%, well over the sector CAGR of 14.5%. Looking at the profitability of Bupa Arabia, which is another success story, we have been the only insurance company that has been consistently profitable over the last 15 years, despite the turbulence that the sector has seen in 2021 and 2022 and in different periods. The stock price is another success story where we have been performing extremely well over the past 16 years, with the Bupa Arabia stock being one of the best performing stock in the Saudi Stock Exchange. In the next slide, we're just going to give you a quick refresh of our 3B strategy, which was introduced in 2024. And the strategy aims to transform Bupa Arabia from an insurance company to a healthcare company. And our strategic pathways to achieve the 3B strategy are centered around boosting the core, which is our insurance business, looking at our value proposition, improving the reachability, and continuing our market leadership. The second strategic pathway is bending the curve, which is around containing the medical inflation and the medical cost that have been on the rise ever since COVID has ended. And in doing so, we're going to leverage the different data analytics tools and building strategic partnerships and introducing different initiatives to help us combat the medical inflation. The third pillar is the Beyond PMI, which is the pillar around the vertical integration, which helps us achieve our ambition to become a healthcare company. And today we have a section introducing more on the performance of our wholly owned subsidiary, Bupa Care Connect, and we'll give you more insights on that later on. Now, looking specifically on the financial performance of Q1, alhamdulillah, another strong performance where our earnings before tax have actually reached 444 million, which is a 6.7% improvement from the prior quarter. That was achieved through the marginal increase in our top line in insurance revenue, which is a factor of the strong performance we have seen in Q4 of 2024, which cascaded to insurance revenue in Q1 of 2025. That was supported by the improvement we've seen in our insurance results margin, which are actually primarily driven by the seasonality shift. So Ramadan this year has actually shifted 10 days between quarter 2 to quarter 1, which meant that Ramadan entirely has been in Q1 2025, which benefited the seasonality of our claims, and we have a separate slide that discusses the inflation and the seasonality and how it impacts our quarterly results. Investment income is another growth story where we have improved it by 17.7%, and that's driven by the improvement, the growth in our investment portfolio and the improvement in the performance. Now, just in the next slide, bridging the gap between Q1 2024 to Q1 2025. And the profitability improve has been driven by the increase out of our insurance results, coupled with the increase in our investment income, which has been offsetted by a growth in the other expenses. Now, the other expenses growth is two factors. One is the continued investment that we are doing in the business to help us achieve our strategic ambition. And secondly, last year we have seen some non-recurring income or other income that was not present this year, which resulted in that variance. Now I'll hand it over to our Chief Investment Officer, Ahmed Bajnaid, to give us a view on the investment results.
Thank you, Abdurrahman. Hello and welcome everyone. Thanks for joining our webcast. As mentioned earlier, Q1 has recorded another growth into our investment income results, 186 million for the first quarter, with a growth of almost 18% compared to the same period of 2024. This is a result of the increase in the size of the portfolio and the resilient rates that we've seen throughout the first half of 2024. And as you can see from the previous story that we've mentioned, how we've managed to diversify the portfolio into the fixed income or the Sukuk book that today represent almost 15% of a 14 billion riyal portfolio. The strategy remains the same, to focus on income generating investments. Right now, as we're seeing in the market, very high level of uncertainty with what's going on the tariff war, and whether the Fed is going to act to reduce rates to basically boost the concerns around recessionary fears, while also battling with fears of inflation at the same time. It's very unlikely to have visibility on what's going to happen over the next 3 months. However, we remain constant with our strategy to actually generate capital gains from the fixed income book once rates actually go down. The view is that probably by the end of this year or the beginning of 2026, the picture would be much clearer. On other asset classes, equities remain very opportunistic, but we will continue to invest in the asset class on opportunistic basis without massive deployment in the near future. That's all, and happy to answer any questions at the end of the session. Thank you.
Thank you, Ahmed. Now, looking at our market share and positioning, and just to echo the message that is continuously being said by our chiefs and our leadership, market share is not a metric for our management, and we continue to monitor that for the sake of the analysts and visibility for the shareholders. Now, looking at the total insurance market share, we have reached the 26.8% out of the total market share, which is a few decimal points from the largest insurance player. And the reason of the drop between 2024 to 2025 is actually the loss of one large contract in Q1 2025, which was only present with us for 1 year in 2024. Now, looking at the health insurance market share, it's actually for the same reason. If we were to look back in 2022, 2023, we've always been around the 40 to 45%, and that's the normal range that we typically are found in the health insurance market. Now, looking at the sector performance from a figures perspective, we can actually see that the overall sector profitability has actually deteriorated by 24%, despite the marginal improvement in the top line of 6%. And today, when even looking at the 26 different players, only 7 insurance companies have actually reported improvement in their profitability in Q1 2025 compared to Q1 2024. Now, looking more closely at the health insurance market, in the next slide, we can see that the picture is a bit similar in the sense that there is a growth in the insurance revenue. However, when looking at the insurance service results, we can see that only 2 companies have actually generated profits, while the other medical players have actually reported losses on their medical portfolio in Q1 2025. The overall insurance results margin has actually improved for the sector. However, that's driven by the proportional impact of the top 2 players. Now, in the bottom of the slide, we look at the GWP segmentation. On the corporate, we continue to be the leader in both the corporate and the SME sector, with corporate going down due to the loss of that one contract, while the other sectors in SME has grown in absolute value. Now, lastly, looking at the individual and retail, it's worth mentioning that the Ta'awuniya figures are actually inclusive of the Hajj and Umrah pool, which, if removed, that segment would become quite negligible. Now, I'll hand it over to Mr. Ali Schneimer, who will take us through the market trends.
Thanks, Abdulrahman, and welcome everyone. We always look at the market trends in terms of the insured population in the market. The figures released for Q1 by CHI shows that the total insured lives end of March stood at 13.4 million lives. That's an 11% increase versus same quarter of last year. And we have noticed that the increase has been universal, whether you look at the nationalities, Saudis versus expats, both have been growing, though the expats been growing at double digits, almost at 12%. And this is same for main employee, i.e. the employees as main members or their dependents. All of them have grown with varying percentage between the different subsegments. Having a long look at the insured lives, which we keep looking at, we can see clearly the consistent growth that we have seen since beginning of 2021, when the market was almost at a low mark. Since then, we have seen gradual growth in the insured lives. This is entirely driven by the growth of the job market. Saudi job market has been actually growing nicely month on month, and you can always monitor that by visiting the GoSee website, where they report employment on quarterly basis. We also look at the gap between the insured lives and the insurable market in terms of employees. So on this slide, we only look at the employees, and the gap still exists, although it has improved versus Q1 of 2024. And there are multiple initiatives undertaken by the regulators on addressing the gap. I came across new information that might be helpful for you, that I posted on the chat for a reference document on CHI website, where they actually studied the current gap in enforcement based on the company size. So on this document, if you go to that page, you will see the enforcement by size. And as we have estimated or expected, the smaller the organization, the less compliant they are with the regulations, where the lowest compliance was observed in the micro segment. And micro is organizations with 1 to 4 employees. And it gets improved as with the size of the company. So that's the first official piece of information that is being released publicly on the enforcement based on the company size. If they post updates on this in the future, we will share accordingly. That's it on the enforced and the trends on the insured lives. Now I hand it back on the for the inflation and the seasonality with Nasser.
Thank you, Ali. Assalamu alaikum and welcome everyone. Basically, this slide shows two things. The first one, the inflation and our expectation about inflation and the composition of inflation. The second thing which we added in the previous webcast is our view about seasonality, but this time we coupled our view with the announced revenue from the publicly listed companies. So starting with inflation, we are expecting 2025 to close at 8.2% inflation versus last year 9.8. 2% of the 8.2 is coming from Article 11 being more materialized over time. So this is our expectation about 2025 inflation. Moving to the bottom chart, which shows our claims variability over time and the different seasons within the year. So again, the main factors of the variability of claims is Ramadan, the schooling, vacation, and the different shift between basically the season being winter and summer. These are the main variables that affects the claims in general. As we can see that, for example, Q2 2024 was the lowest season in last year, and we're comparing this with the announced revenue from the public provider just to confirm our expectation back then. So we can see that the correlation is very high between our expectation as at that time and the announced revenue from the publicly listed provider. That's all in terms of BMI and the market challenges. Thank you. Back to Hatem.
Thank you, Nasser. And in this section, as we promised in the last discussion, we'll be sharing an update on Bupa Care Connect, our provision arm, and transactions and activities they've been conducting specifically in Q1 of 2025. If we move to the next slide, we are proud to mention that in the first quarter, we have managed around 200,000 transactions between the different line of services we are offering through our provision arm, some of which have been handled directly through Bupa Care Connect or through partners we are collaborating with in providing our provision value proposition. This includes teleconsultations offered by our doctors and medication requests and deliveries, home-based labs, population health management programs that we've been offering to our members, and the two corporate health centers that we are operating as of now, and more to come. In the next slide, you can see the service offering we have started with, segregated by services Bupa Care Connect is operating directly and services that are operated by Bupa partners. And this is ranging from digital care, including digital consultations and services and healthcare program. In addition to that, our offering includes some of the ancillary services such as e-prescriptions, labs, and medication refills, and in-person care, including the corporate health centers and our support of referral management and inpatient care in the hospitals to ensure that we are delivering on the three promises to our customers, which is higher customer satisfaction and offering a superior service to our members, and ensuring we have a superior health outcome for the members at the most optimal cost, which is the key promise we are offering to our clients. In the next slide, you see the program we are getting and the program we started offering. And as you can know, based on the classification of our members, there are few size of the population, ranging between very sick and chronic. However, those are the ones with the highest requirement in terms of care and guiding their journey through referrals or virtual care or care navigation, through which we guide the journey of our members to guide them to the best care provider for their specific cases, which results on delivering the highest value for the customer from a cost point of view, but also from a health outcome point of view. And not to forget the digital and wellness program we are offering to our generally healthy members to make sure we deliver on our promise to help them live longer, healthier, happier lives. With that, I'll go back to Ali if there are any new highlights that he would like to share.
Thanks, Hatem. On the slide, and I don't want to spend much time because most of these are announcements that have been published on Tadawul website related to the renewal of Saudi National Bank, also renewal of SABIC, plus other announcements related to whether Bupa Sports product or the announcement for the employee stock program purchase or the previous year's dividends. On the regulators front, there are lots of actions taking place, not yet with, we are anticipating the approval of the National Insurance Strategy by Insurance Authority, which will lead to the development of the new set of regulations that we are highly anticipating this year as a key transformation for the sector, because this will be the first upgrade to the regulations since the beginning of insurance in Saudi Arabia. And hopefully we will get more updates on that during the coming few months. And once they are publicly available, we will gladly share this with the investment community. And probably the best for us is to spend good time in the Q&A. The brag sheet is there. Recently we have won 2 awards from CHI, Excellence Awards for Bupa Care Connect. So despite still a newborn, so 1 year and a half old, it has already won 2 awards, which gives us great confidence in the delivery of Bupa Care Connect and its contribution to our business. Also a week ago, Arcom, which is a leading market insight portal, held an award recognizing the top CEOs, and our CEO Tal Nazar has been recognized as the best CEO for the insurance sector, amongst other awards that we feel happy when we receive them, and we share them with you. And this is just a sample list of our customers, and I think we wrapped in almost 25 minutes, which will should give us enough time for a Q&A, which I believe you value and you anticipate that, and we value your interactions.
Thank you very much for the presentation. We can move to the Q&A. If you have a question, you can click on the raise hand button and I will unmute your microphone, or you can also write your question in the chat. We have questions from Shiro Ghosh. Please go ahead.
Hi, this is Chiro Ghosh from SICO Bahrain. The first question is related to your GWP. So I understand your GWP was relatively lower than last year because of one large contract. Can you help us know, excluding that, that deal, how much was the GWP growth? Just want to get a sense. I mean, on a like-to-like basis, how much has GWP grown, and what is your strategy going forward? Like, which are the sector you would be targeting? That is my first question. And second question is related to your investment income. So if interest rate actually starts coming off, then how do you see the investment income going forward? These are my two questions.
I'll take the first question and then I'll hand it over to Ahmed Bajnaid. And I think the first question is a smart way of approximating the size of the contract, but I will not give a percentage. I will just say that if that contract was removed, you would have seen a growth in GWP.
And which are the sectors you would be focusing for the rest of the year? I mean,
So there is no change in terms of sector focus. We're following the same plan we've been following. Maybe, as we mentioned earlier, we believe we have an opportunity to grow more specifically in the small and micro, for which we started with our new offering digitally, which is a new platform we launched recently to make sure the journey is smoother. So that's a segment we believe we have an opportunity to grow in. In terms of industries, it's been the same focus for the previous years.
On the investment income part, so rates actually have already started coming down. You've seen it since the Q3 of last year when the Fed started cutting rates. The problem is that yields have been very, very volatile, as you've seen in the market. So the impact is that renewing your short-term investments will come at a cost. But this is what we have done by putting our investments in fixed income while extending the duration, so we can actually benefit when yields come down. Now the question is when and by how much yields are going to come down. With everything that we're seeing, the visibility is extremely low. When it happens, the idea is that this is going to generate a decent cushion of capital gains that we can sustain the investment income results. Other than that, it's just really making the best out of the cash that you right now have, so we can invest in short-term investments or slightly longer-term investments, or even equity if you believe in the story over the short term. From our end, we don't see an impact on our investment income result in the short medium term, given that we've extended the duration already.
Okay, that's all from my side. Thanks.
Thank you. We'll take questions now from Abdallah Al Buraidi. Please go ahead.
Hello, thank you very much for the very great presentation and congrats for the very great results. A question regarding the seasonality impact. So based on what you said, that the net insurance margin has increased to 8%, that was due to Ramadan being all in the first quarter. If we normalize Ramadan impact and take like for like, what would be the net insurance margin?
So this is, it's hard to isolate that impact because there was other factors and initiatives taking place at the same time. But it is fair to say that majority of the improvement came from seasonality. But even if we take that out, you'd expect to see a slight improvement behind the initiatives that took place around the same time. But as I mentioned, it is, very difficult to isolate it without the impact of the different initiatives on cost optimization.
So if we, for example, take the last 10 days of December and remove the last 10 days of Ramadan and compare this to first quarter last year, I know it's
That's
a naive way to do it, but would that be, if we can put numbers on it, would that be around 20 basis points or something?
Actually, that would be worse than the reality because you're adding a high seasonality days.
Okay.
So that would be even worse than reality. But reality is slightly better, but seasonality played an important role in Q1. And not to forget, by the way, I think you are raising an important point. The base for Q1 2024 was already much higher than, for 2024 was much higher than 2023 already. So this is an improvement on an already very good base. So even if you adjust for the seasonality, you would expect to see an improvement versus year ago.
Okay. And for the contract that was not won, I understand that it only covers maybe a single month. But would you classify this contract to have a higher loss ratio than your average portfolio?
Usually, large contracts do. So usually, the larger the contract, the higher the loss ratio of the contract, especially with when it's large contract including parents or retirees. The bearing cost of such book is higher. So, and this was the first year. So for us, the first year is more of an investment year where we invest in the operation and making sure we build the infrastructure to serve the client in the best way possible. So I agree with your rationale, and it is correct that for such year you wouldn't expect a big contribution from that account. So if you remove it, you wouldn't expect much change.
Okay. Maybe just one last question and maybe a suggestion regarding the enforcement gap. Could you classify the government employees that work under the civil service law, which are not obligated to be insured on, and segregated from the really goosey primary, which work either in a private sector or semi-private sector, which are obligated to be insured on under the labor law? And tell us what is the enforcement gap if you have the number.
Very, very hard to do that, given that we don't have the detailed data. Because for those who are under government today, we know what we have in our book, but we don't know their size in the market in general. That's why we use the GOSI figures when majority of them, not all of them, but majority of them would be under GOSI. And we compare that to the insured employees just to have a feel of the gap. And probably the enforcement gap that we report here that are based on the publicly published numbers might not be the most accurate because you need to remove that from both the insured lives and you remove them from the GOSI figures for you to get the accurate enforcement. That can only be done by government authorities who have access to the detailed data.
Okay. Thank you very much. I will go back in the queue.
We'll take next question now from Ankur Agarwal. Please go ahead.
Congratulations on these results. Am I audible?
Yes, you are. Please go ahead.
Hello. Yeah, okay. So 2 questions from my side. My first question is regarding the inflation numbers actually trending down, medical inflation, still in high single digits. But how much role has Care Connect or DRG played so far in the inflation numbers trending down? And what role do you think it's going to play in the coming years? That's my first question. My second question is regarding the national insurance strategy. There is some discussion or murmurs in the market about the strategy actually trying to tackle the very high market share concentration within the health segment. Do you think it's feasible, and in your conversations with the authorities, did you get a sense that that's one of the objectives of the policy? Those 2 questions. Thank you.
Thank you, Ankur. I'll take the first question and then I'll hand it to Ali for the second question. On the first point on inflation, what you are seeing is a behavior of the market mainly. To your question on the 2 points on DRG has 0 contribution because DRG is not yet implemented. There is a reporting aspect that is ongoing, but there is no impact of DRG whatsoever for now. In terms of optimization from Care Connect or other initiatives, we mentioned earlier that the interventions we have in place, we believe at maturity could deliver 1 to 2% of optimization for the book overall at maturity. And as you know, Care Connect is a company that has been operating for 1 year, and already you see the magnitude of the impact they are delivering on the first quarter compared to our full book, which has more than 3.7 million members. So we expect that to build up gradually over time and then deliver the level of optimization I mentioned. Ali, if you want to add something on the strategy of insurance.
If you could, Ankur, repeat it. I was distracted answering the question on the chat.
Yeah, no worries. So I think the question was that, I mean, in your discussions with the authorities, have you got a sense that the national insurance strategy might try to look at the concentration of the two largest players in the health segment? Is that a risk, or do you think that nothing of that sort is on the agenda? That's my question.
Okay, clear. We haven't discussed that in details. However, there is an independent authority today in charge of competition and concentration. That's the called GAC, which is the anti-competition authority. And I remember probably 3 years ago, they have conducted a full study on the insurance sector, and they have published that study on their website along with the recommendations. Rule of thumb is as long as you abide by the regulations and you don't practice any wrong practices that impact the competition, nobody will stop you from growing because you are doing the right thing and customers use you for the right reasons. And we believe we have been doing that. We have been entrusted by customers. And we are one, if not the most compliant with the regulations in the market. Once they publish the detailed strategy, it has components to the concentration. We will discuss them as they come.
All right. Many thanks, Ali and the team. Many thanks. I'll join the queue again. Thank you.
We'll take next question from Michael Christelis. Please go ahead.
Hello?
Hi. Yes, we can hear you. Go ahead,
Yeah,
please.
great. Thanks. Thanks very much for the time and a good set of results. 2 questions from me. Firstly, on the large contract that was lost in Q1, I'm intrigued, and my clients are too, as to why a large employer would move insurers 1 year in a year and then move again within a year. I mean, can you give us any indication as to why they've moved back to the previous insurer and maybe what lessons you've learned from that whole exercise? And then the second question relates to your investment portfolio. I see there's quite a large investment gain through other comprehensive income. Can you give me a sense of the sensitivity of that? What drove that, and how should we think about that moving relative to bond yields or interest rates, or what the key driver is behind that number? Thank you.
Sure. Let me take the first question on the large contract. As per the official response we received from the client is that the discussion got to pricing discussion at the end where they had to award the lowest bidder, and that's the official response we got. And I think for usually what we do for such large contract is to make sure that we have the multi-year formula, which is a practice that was introduced by the insurance authority, where you price the contract on multiple years. This allows insurance companies to invest in the service and make sure they invest in a setup specific for large contracts to deliver higher quality of service, knowing that there is a multiple years renewal in place. And I think this is the right thing to do, especially for large contracts that requires a special setup for their policies. And I believe this is one of the learnings that needs to be taken into consideration in the future.
Great, thank you.
Yes. So before the tariff came down, the tariff news came out in April. The expectations for the year that there will be rate cuts, and yields have actually went down, relatively speaking, from levels in Q3, Q4 of 2024, and we had unrealized gains at that time.
Can you talk a bit about how the portfolio responded to the tariff noise and chaos in the market in April, or not?
Zero reaction. The portfolio itself, in terms of P&L impact, was very negligible because it's just accrued income from money market product, including deposits, as well as coupon from fixed income. So the P&L impact was very muted. The OCI impact, for the tariff, is that basically the unrealized gains have actually came down, given that yields have spiked. But this is just an impact.
Thank you very much.
Yes, on the balance sheet.
Great. Thanks very much, guys.
Thank you.
We'll take the next question from Jinal. Please go ahead.
Hello, am I audible? Hello.
Yes, we can hear you. Go ahead, please.
My first question is on operating costs, which have increased by around 40% in Q1 25. So could you share what's driving that rise? Is it structural investment, any regulatory compliance, or one-off? Also, are there any efficiency measures or digital initiatives in place to help moderate this cost trajectory going forward? And my second question is on underwriting margin, which have been typically, range between 5 to 6% over the past few years. So do you view this current margin levels as sustainable for the remaining of the years, especially for the ongoing medical inflation pressures? Thank you.
So let me comment on the underwriting margin, and then Abdulrahman can also shed some light on the expense ratio. So for the underwriting margins, as we mentioned earlier, if you look at the previous years quarter by quarter, you would see that Q1 has been improving gradually over time due to the seasonality shift to Q1. Even though when you look at the full year margin, you would see it more or less flat with slight improvement, but more or less flat on 12 months basis. So the improvement you see is to a great extent driven by the seasonality shift. And then you could see that consistently happening for Q1 over the past years.
And just to jump on the other operating expenses, now the variance between the two quarters comes from two different factors. One is that, again, as part of our strategy, we continue to invest in the business in multiple ways to support our ambition. Secondly, last year there was a reversal of certain transactions that were not recurring, which reduced the other operating expenses. Now, looking holistically and looking at our ambition for the full year, we're still committed to sustaining and improving, as part of our ambition, sustaining and improving the combined ratio, and we will continue to monitor those metrics to ensure that we are efficient. Today, we have investments in our digital arm, and when you see our first step into vertical integration, we started with a digital healthcare arm that will expand beyond digital, but We started with digital because we understand the magnitude and the impact that a digital infrastructure can have in the future in us managing our expenses and serving our client. So we do have a lot of efforts. However, you should expect to see some variances within the other operating expenses because some of these investments are being realized through a lower cost in our claims. And therefore, it allows us to manage the combined ratio in a much more efficient way.
We'll take the next question from Waruna Kumarage. Please go ahead.
Hello, hi, good afternoon, gentlemen. Am I audible?
Yes, you are.
Yeah, hi, thank you. And I have three questions. The first one is related to the GWP growth. I mean, if you exclude the large accounts, both small and medium accounts, I think there was a decent growth, 15 to 20% growth in first quarter. Although, I mean, last year you didn't grow these segments much, but this year you were able to grow. I want to know, firstly, was it driven by additional entities coming into the portfolio or the increasing members in the existing companies? Or so what was really driving this first quarter growth, or whether it's sustainable going forward? And secondly, I mean, since you are a part of this Expro account, I mean, you are one of the three companies who are participating. If you could tell, I mean, ballpark figure, what kind of share you have from this Expro business? And lastly, I mean, apparently, I mean, from one of your competitors, they were telling that there is a kind of initiative from the insurer side to push for a pricing increase in these Expro accounts to make it, profitable. So I just want to know whether you can share something on that front. Thank you.
Hi, Varuna. Your voice was not very clear on some parts, so I will answer, but please feel free to stop me if I'm not addressing your points. So your first point is on the SME segment, and I kind of alluded to it slightly earlier, where we actually have a couple of initiatives in place, and it's not done yet. So the benefits of those initiatives are still expected to come in the future, but one of which is the improvement in the acquisition journey of some of the members through our digital platform. And we did execute another initiatives in which we developed a more customized pricing engine with more customized factors. So to get to your point, yes, we believe this is sustainable, and we believe we still have some room to grow in that segment. As you can see, the smaller you go in terms of segments, the lower the market share we have, and we believe we can cater our offering to do better in that segment. So yes, we believe this is sustainable and still some room for improvement. Your second point was on Expro, if I'm not mistaken. And our share in Expro is similar to our market share overall for the book. So we are not, none of the players has a huge advantage when it comes to market share, when it comes to Expro. And Expro had a higher inflation over the past year, driven by the fact that the policy design and the network is actually was very rich, catering for members and their parents. So and by default, such policies with richer benefits and higher age groups tend to have higher inflation, hence requiring a higher price increase to maintain the loss ratio. So that's the case as highlighted in the previous call for all players. So to maintain a healthy loss ratio for Expro, yes, that requires higher price increase versus the rest of the segment. which, by the way, it's not only Expro specific, but even other rich policies that are not on Expro would require higher price increases to sustain the loss ratio.
Okay, thank you. That's very clear. And just to, I mean, if I'm to follow up, since you mentioned about this digital platform for SME, I want to know whether, I mean, are you by any chance using any of the aggregators for this SME, or you want to go on your own?
As of now, we are not on any of the aggregators, and that's an area. I mean, we could entertain if we believe there is an added value for the segments we are targeting. But as of now, we are not on any aggregator.
Okay, thank you, Hatem. Thank you.
Thank you.
We'll take next question from Rene Selouan from Jadwa. Please go ahead.
Yes, hello. Thank you for the call and the opportunity to ask questions. My question is also on the other operating expenses. Usually in the first quarter, if you look over the past 3 years, it's been the lowest in the first quarter. So that's why also I'm wondering why it was so high. You said there were some reversals from last year, but historically it was always very low in the first quarter. And second, there was some losses on onerous contracts in Q1 of 25, but there was also some in Q3 of 24, which got reversed the following quarter. So I'm just trying to understand. You booked in third quarter, then you reversed them in the fourth quarter, and then now you booked in the first quarter. How does this work? And if you can also tell us which segment does this relate to? Is this the SME? Because you grew the business in SME, you're taking losses on that business, or is it the Expro segment? Which segment does this relate to?
Maybe let me start with the operating expenses, and then I'll ask Hatem to maybe comment on the loss component. Now, looking at the quarterly movement of our other operating expenses. So last year we had, if you look at our financials, we've had one of our lease contracts being terminated, and that resulted in an income that offsetted the other operating expenses. So that removes an element of comparability between the two periods. But one thing to note is that as part of our 3B strategy, the way we're incurring our expenses and the pattern of our expenses is not very comparable as we continue in our ambition to become a healthcare company. And as I mentioned, any investment that we do in other operating expenses is in line with our strategy and is aligned with our budgeting process, and it's aligned with our ambition to improve the business. For that's on the other operating expenses. Hatem, do you want to comment on the loss component?
Yeah, so actually what you are highlighting, Rene, is normal. So basically you measure the loss component based on the forward looking of the contracts you have already written. So by the closing of the year, the full seasonality of the book has been absorbed. While what you're looking at now with the healthy seasonality shifting more toward Q1, you realize more of the benefits in Q1 of this year compared to last year, while you book a loss component due to the seasonality of the book for the coming periods, which again is expected to be booked throughout the year and then adjusts toward year end once that seasonality effect is ironed out. So it is normal that you reverse it in one quarter and you add it in the other.
Okay, and to which segment does this relate?
So we have in the reporting there has been some changes where before we used to have it corporate SME, but now with the new methodology as required by the Insurance Authority, you have the segment by month rather than by quarter, and it's splitting also corporate, SME, and Expro. So that these are more splits by month, resulting in that impact. Now, again, just to highlight, this is due to seasonality, Rene. So it's not a loss unless you look at the 12 months period. Now, SME continues to be healthier than corporate for our book, similar to the history. So there has been no effect in SME behind the gain we got. It's still healthier than corporate.
Okay. And also in the reserving, you also reversed changes that relate to past service. It was a large amount. Can you explain that, please?
Nasser, you want to take this?
So basically, we see this movement. You're saying a large amount, however, because the reserve balance is around it. We're forecasting 18 billion Saudi riyal. So if you monitor this movement over year, it's almost consistent with our reserving release pattern and methodology. So nothing changed this quarter over last quarter or the previous quarters.
Okay, thanks.
Thank you.
We will take the next question from Abdallah Al Shamsan. Please go ahead.
Hello, am I audible?
Yes, you are.
Thank you, gentlemen, for the great presentation and congrats on your results. So I have a couple of questions. So first, can you explain how pre-authorization claims works with hospital? Are they based on a capped billing model? And if actual services go beyond the cap, who ends up covering the extra cost? So please expand more on the payment mechanism.
So pre-auth and the contractual agreement with the different providers are different. So there is no one setup for all providers. It's different from an account to account. Now, if whatever service is required for our members has to be covered. If the member is eligible for the service, it will be covered. So and the healthcare model in Saudi is heavily dependent on fee for service. We are not yet at a stage where value-based healthcare is fully implemented. There are trials here and there with some of the providers, but it's still heavily reliant on fee for service. So if a member is eligible for a service, the member will receive the service and it will be compensated by the insurance company.
So it's a capped or not?
No, it's not capped.
So okay. Like, I have another follow-up question. So if I look to your the people or the healthcare providers that you worked with as a pre-authorization, most of the hospitals are not, I would say, not well known, like Habib, Faqih, and the other healthcare providers. So why is your pre-authorization with the healthcare providers, I mean, less in quality?
I'm not sure how did you get the less in quality. I mean,
they are fragmented. It's not scaled like Habib, Faqih, and Hamadi, other Mossad. Why it's only on not unknown players?
No, sorry, I'm not sure I got your question. Can you explain it?
My question is, if I look to the healthcare providers that you contract with on a pre-authorization model, you would see that those hospital or healthcare providers aren't well known, like Habib or Faqih. The most known healthcare providers, Saudi German, I think, and SMC, and the other players are, they don't have that brand name. Could you do that same deal with Habib and Faqih?
But pre-authorization is implemented on everyone. So pre-authorization and the protocol are implemented on everyone.
Hello?
Yeah.
Sorry to interrupt. I think he's referring to the no authorization Bupa Pro, if I'm not mistaken.
Is that the question, Abdurrahman?
Sorry?
So you are talking about the no pre-authorization approval with the providers we
Yes,
okay.
exactly.
Sorry, thank you, Ahmed, and thank you for the clarification. Okay, now I got it. So actually, this is a contractual agreement with those providers, depending on the need in the different networks. We do contract with different providers, and the different providers are welcome to join the program based on a specific criteria. Some providers are open to join the no pre-authorization network. Others cannot join it for different reasons, or because that would require a certain level of control applied from Bupa. So it is a contractual agreement similar to any agreement we sign with the providers. Some are okay with it. Some have some restrictions, so they cannot implement.
Okay, and is it a capped model?
No.
Is it a capped?
No, so the main criteria for those providers is to follow the protocols we follow for pre-authorization and educating the claims. So if they can follow the protocols with the transparency needed, we can process their claims with no pre-authorization. And the setup of that agreement is, is set between the two parties. So it's not something that I'm at liberty to share with you here.
Okay, so one follow-up question. So if I compare a hospital that did that deal with you and other hospital that didn't, in terms of rejection rates, is it, similar or different, or it's not related?
No, it's not related. So for those providers, they are implementing the protocols that we would implement if we receive those requests. So they're doing it upfront before we receive the request in the first place. So the setup is very different.
Okay, clear. Thank you very much.
No problem.
We'll take the next questions from Salome. Please go ahead.
Hello, can you hear me? Hello?
Yes, please go ahead.
Yes.
We can hear you.
Yes, thanks for the presentation. I have two questions. You have relatively low acquisition costs as a percentage of insurance revenue compared to the Tawniya. So how shall we look at this component of the cost in light of the weakening market share? And the second question is on the portfolio. Around 40% of your portfolio is allocated to the term deposits. And if you could give us little bit more information on average duration and the sensitivity to the interest rates of the deposits. Thanks.
Sorry, can you repeat the first question?
Second or first?
First.
First question is on the acquisition costs. So its share fraction to insurance revenue is relatively low compared to Tawniya. And given the weakening market share of Bupa, how shall we look at this cost component going forward? How can we project?
Maybe Hatem, let me start and then maybe you can supplement. So اليوم today, when looking at the policy acquisition cost, you have to look at the composition of each entity, and you have to look at the different components that are within that policy acquisition cost, and it's impacted by levies, commission, and so forth. So while we wouldn't be commenting on the competition, we monitor our policy composition cost, and it continues to be relatively flat with marginal improvement as a percentage. And we don't see any movement between the last few years in our policy acquisition cost. However, I would urge maybe to look at more specifically the line of business and look at the composition of the two companies to understand the variances in the policy acquisition cost. Ahmed, do you want to take the next question?
Sure. The average duration for the portfolio is a little over 3 years. Don't have it on top of my mind for the deposit specifically, but we also have some exposure to long-term deposit that we've invested in at the end of 23 and the beginning of 2024.
Thank you.
Sure.
All right, we'll take a follow-up question now from Abdallah Al-Buraidi. Please go ahead.
Hello, thank you for letting me ask again. Just one question. We noticed that the insured lives has increased by a percentage more than the increase in GWP, which might be, or of course, it's a reason of lower grades insured lives than the current insured lives profile that we're having. So, is there any index that we can use to track the price per policy for like? Because if we take the insured lives, the GWP and divided by insured lives, this will be impacted by the grades of the insured lives coming into the pool.
Sorry, Abdullah, you are referring to the insured lives from where?
The slide that you are showing.
At the beginning?
Yes.
Yeah, but we have been at that level or that range for a couple of quarters. So there is no major increase versus the previous quarters.
Yeah, but my question is that how can we track if there is an increase in the policy price like for like? For example, a policy for company X to compare it year over year.
So the number of lives is not reported. Exactly in those reports, and it's not in any company's reporting. But we have been at that range, so we have not. So to your comment that we gained higher number of lives with lower premiums it's not the case. Our average premium per policy has been on an increasing trend in line with the inflation as we've been passing the price increase to maintain our loss ratio over the past year. So there has not been a surge in terms of life compared to the previous quarters.
Okay, could you give an average of a growth in insured lives in the different brackets?
No, I don't have that.
Okay. Okay.
In terms of premium, you do see an increase across the segment, all segment. The only exception would be in the corporate segment, specifically related to the large contract we lost in quarter one.
Okay, clear. And just an accounting question. So, Care Connect, on accounting wise, do you put all the revenue in the other revenue and all the costs in the other costs, or those are other components that go here and there?
Okay, so Care Connect today is a wholly owned subsidiary that purely serves Bupa. So any revenue and intercompany billing between the two entities are actually netted off in the financial statement. So what you see are other revenue and other costs relates to our other subsidiary and other pockets of revenues. Today, what you see in Care Connect are expenses and a reduction of claims that are being served through Care Connect, which is why our comment on the combined ratio being a more representative view of our business in the future, because you will see that shift of some of the claims being served by external providers being actually treated through our subsidiary, which the financial statements through the consolidation eliminates the revenue of Bupa Care Connect and eliminates the claims in the insurance business. And therefore, what's remaining is the expenses and the reduction in the claims.
Okay, and where does the expenses go? Is it operating or other costs?
Part of it, and again, there is a whole methodology around expense allocation. A portion of the expenses would go to insurance service expense, and a portion of that expense goes to other operating expenses.
Okay, thank you very much.
We have a final question, follow-up question from Waruna Kumarage. Please go ahead.
Hi, thank you for taking my question. It's actually, I mean, just two questions related to the SME definition. Can you tell me what is the definition for in terms of headcount, small, medium, and micro? And then on Care Connect, since you have treated, you mentioned 74,000 lives in first quarter. Is there like a target that you have in the medium term?
So we are following the definition of the Ministry of Commerce on the SME segmentation. So micro is 5 employees, and then small goes up to 20, etc. I mean, you can find the segmentation in the Ministry of Commerce. And on your second point, we are not sharing any guidance on SME targets specifically. But as I told you, we believe this is a segment where we can still grow our market share.
No, actually, I was asking about the target for the Care Connect, the number of lives you want to serve, like in other one.
Oh, sorry, yeah, okay. So okay, on Care Connect specifically, we mentioned earlier on in one of the sessions that we believe our offering could cater to up to 1 million members in our book. So that's our full target to reach in terms of offering to our clients.
So right now your total is 3 million, right?
Come again?
I mean, you serve about, I mean, your total member count is around 3 million right now?
We serve around 3.7 million.
Okay, right. Thank you, Hatim. Thank you.
No problem.
I can see a question from the chat that hasn't been answered yet. What is the average duration of your bond portfolio?
We mentioned that, Ahmed mentioned that it's a little more than 3 years.
Yeah.
All right, thank you. There are no additional questions, and therefore we can conclude the call. I would like to thank the management team for their time and all the answers provided today, and thank you to all the attendees for joining. And I'll hand it over to the speakers for any closing remarks. Thank you.
Thank you very much, and thanks for everyone for joining. It's always a pleasure to receive your questions, and hope to see you again soon at the earnings call of quarter 2. Thank you.